It's time for the single best chart. David Riley and Bluebay of Bluebay Asset Management, Stephen MacKlow-Smith of JPMorgan Asset Management are still with us. And guys, this is my single best chart. Now, this is a very simple Dow Jones chart, but we actually charted it, thank you to Hillary Clark, with a 50-day moving average, with a 100-day moving average, and with a 200. And this is on the back of a viewer this morning that wrote in saying, I think, this is what he says, we see a rebound in U.S. markets once the Dow gets closer to its 200-day moving average. Stephen, thoughts?
I think, it's clear that some traders think about moving averages as key lines of support, but the more important issue to me as an investor is what's happening to earnings. And of course, as a result of the tax cuts, corporate America is seeing growth in earnings this year on a scale that other areas simply aren't seeing. So the expected growth is, 18 or 20%. Now, back in January, when the market was peaking, valuation, to many people's minds, looked demanding. The index is off quite substantially since then, and at the 200-day moving average, that will be a significant correction. And yet, it's correcting into significant earnings growth. So the valuation story is somewhat going away. So investors will get more interested.
Do I sell Europe at the moment? So if we're talking about averages, Europe's 50-day moving average has gone through its 100 and its 200. Death cross, they like to call it in technical land. Does Europe look... Has the momentum faded from Europe now? Is that trade beginning to get done? 2017 was a great year.
It was a great year, and I think you also need to think very carefully about the currency effect within that, because in local currency, which people tend to look at, Europe hasn't looked great relative to the rest of the world or relative to America, but in dollars, it was, the second best performing area in the world last year, just tucking in behind emerging markets. So, it slightly depends what's going to happen to the euro. My sense is that in the middle of last year, people were really concerned about excessive euro strength simply wiping out the earnings story, and as far as we can tell, that is not happening. We're not seeing upgrades, but we're not seeing downgrades, and therefore earnings growing at about 8 or 9% this year still looks a reasonable expectation.
I mean, I certainly do, share the view that the outlook for Europe and European assets should be positive. I qualify that by saying that I think part of the backdrop to what we're seeing at the moment in markets as well is that actually the European data has been coming off. I mean, the PMIs have been coming off and the sentiment, and admittedly from a pretty high level, but nonetheless, it's important for risk assets, credit as well as equity, if you like, is the momentum, is the change. We front run. If that momentum comes off, it's a bit more problematic.